Thanks everybody for joining us. Right. Today we have an interesting and international group of health actuaries as our panelists. They have varied business and geographical backgrounds. But I realized the common thread is that they and myself are actually current and past volunteers with various actuarial associations. As a plug, I do recommend everyone to have a look and sign up to volunteer for your association. Adrian has over 30 years of UK, South Africa, and global experiences. He's responsible for pricing and underwriting for Bupa UK's and global's business. He's currently the Chief Commercial Actuary at Bupa International. He spent 20 plus years specifically in health insurance and is currently the chair of the IAAHS and also a member of the IFOA Health and Care Board. Kirti has 10 years plus as a health actuary in India and Singapore. She has masters in pure mathematics, and to round off on the applied math side, she's both a fellow as well as a chartered enterprise risk actuary. She has been busy these couple of years as head of health products and pricing at AXA and implementing various industry level changes on integrated shield plans in Singapore. Lydia hails from South Africa and is now based in Singapore. She has 10 plus years of experience as an actuary and almost half of her recent experience in health. Right? She is currently Associate Director of Insurance Consulting and Technology at Willis Towers Watson. She is also a volunteer on the Health Insurance Subcommittee of the Singapore Actuarial Society, together with Kirti and myself. Spencer already did his tour of duty as a SAS volunteer. He is currently the Head of Health for Southeast Asia at RGA. He spent close to 10 years doing health and studied in not one, but two of the most elite universities from both sides of the Atlantic. Myself, my name is TY. I'm not an actuary yet, but I have spent many years volunteering with the SAS and the Health Insurance Subcommittee. I have working experience on both sides of this debate, meaning the insurer side as well as the medical provider side. I'm currently Chief Commercial Officer at Healthway, which runs close to 90 GP and specialist clinics in Singapore. I'll be moderating today, mainly as timekeeper, while our esteemed panelists share snippets from their storied careers in health. Right. Okay, can you see my screen here? Okay, so our agenda today will be talking about leadership, about leading health insurance, leadership and execution using actionable data. Our agenda will be distribution, underwriting and pricing as part one. We will take a break for audience Q&A. For part two, we'll be talking about claims and medical providers. And we'll also take another break for Q&A. And last but not least, market developments and regulators. Just as a disclaimer, all the views expressed here belong to the panelists as a member of the profession and in no way represent what their employer's position is. The other point to note is that do keep the questions coming. Use the Zoom Q&A chat function. Okay, to start off, right? It has always been clear that in insurance, the largest pool of people covered will result in the lowest price for a given benefit. But in the context of health insurance, there's always a challenge in ensuring people buy in while they are healthy. So my question for the panelists would be, where are the future opportunities and quick wins that insurers should get? Kurt, you want to start us off? Kurt, we can't hear you. Sorry, Kirti. We can't hear you. Hi, can.
Oh, can you hear me now?
Yes, now we can. Yeah.
Okay, I'm so sorry. I don't know what happened. Okay, thank you, Levi, for the introduction. So the question you just asked, I think it is a very important question. And one of the ways to look at it would be how to basically increase the pool of the customers any insurer has. Now, one thing which comes to my mind is the digitalization and the micro-targeting, on which the insurers have been focusing in last decade and specifically in last 5 years. There have been huge investments in the digitalization of the insurance, specifically under health insurance. But what we notice, majority of the time, these projects, the outcome does not match the objective, or the KPIs are not really delivered. And why so? So here is my perspective. I think when the insurers start looking at it, they think from a perspective of offering a product, which is an existing health insurance product, through digital means, like any of the retailers. So, for example, Amazon, they put their products online, and then people search for those products and they are able to purchase. But the fact of the matter is, no one actually goes online and tries to purchase an insurance policy. So, okay, there is a message that my connection seems to be a bit choppy. Just give me one moment only. I'll open the door.
Welcome to this Zoom COVID world.
It was okay. I don't know what's wrong, but sorry for that. So digitalization, I was talking about the digitalization. Now, so why does it not really work? Because we offer the product online, and then we think, and there's a content manager designs the content like this so that the Google search engine puts our product or puts the insurer's product on the top. And then we think the insurer people will come and purchase our products and our sales will go higher. But why is this model not really working? I think there is a specific reason. The reason is, as I mentioned, people don't really want to, or they don't really Google to purchase the insurance products. Insurance products are to be sold. They are not really purchased. We all know that. So that's one gap. Second, all the insurers have developed very nice, beautiful apps which you can access through your phone, a lot of investment. But where it lacks is because customers do not really download those apps. Sorry, most of the customers download the app only when they really need to file a claim. So I think I can recommend some alternate strategies which might help. One of the strategies can be when the customer comes, or basically the insurance is purchased, to have the peace of mind when the customer is going to claim. So when a customer comes to claim on the app, we need to provide a seamless, a very nice and amazing experience to this customer. This does not mean we pay all the claims. This also does not mean we have to have a very shorter TAT to make the customer happy. I think what it means is the journey when you file the claim, starting from filing the claim, sharing the information about the claim, what stage the claim is at. All this is very important in terms of the experience. So we need to give a very nice user experience to this customer. And when the customer is pleased with this experience, we take a feedback and we collect the data. And we use this data to offer an engagement strategy. One of the examples I can think of is, a customer has filed a claim for the back pain. And we know that this customer is suffering from a back pain. The moment we know this, we can offer one of our wellness services, or insurers have so many wellness services today. So offer something which. Am I not audible?
Can. So 30. I think that's definitely a good point. I think some of these points we will discuss a little bit later. If you don't mind, I'll move on to the next question.
Okay. Even just to last sentence. So I was coming to a point where basically once we have engaged the customer, we can actually offer the cross-sell and the upsell opportunity. And behind this, we need to have a model setting for which we need the data. But on day one, even if we don't have the data, we can start collecting the data and offer something very logical. But this is one of the ways to actually increase the insurance pool of the customers for various products insurer is holding.
Yeah. I think our conference yesterday as well as today, I think there were topics that's quite similar and containing real life cases. Right? So the question for Spencer, would be in relation to data, right? Kati talked about it. So how do actuaries hunt or data, whether it's internal or external, in relation to new initiatives around underwriting, or one hot topic will be guaranteed issuance products.
Okay. Thanks, Ken Yong. You can hear me, right?
Yeah.
Okay. Yeah, thanks for the question. Before I go into the data part, I just want to mention a few points about underwriting and how it has evolved over time. So obviously, underwriting is a key part of the sales process, and the way we do underwriting has evolved with the changes in distribution and sales channels. In some markets, the insurance companies have gone very quickly into the digital sales space. They do this end to end. They allow the customers to look at the product information on the website. They allow them to do this via the mobile apps as well. The customer can contrast and compare the plans and benefits. They can then decide which plan they want to go for. They do the underwriting process online, and then if they choose to proceed, they can receive the approval and the policy documentation electronically. So this is what is happening in some markets already. And in other markets, which is still using the so-called traditional sales channel, using financial advisors, using insurance agents, they are also trying to go into the digital space, partially. Some of this is done at the front end where they allow the customers to look at the information on their website, on their mobile apps. And then when it comes to the underwriting process, to the signing process, it goes out of the space into, is done offline, for example, for various reasons. So regardless of how they have gone into the digital space, whether they do it end to end or partially, the trend is pushing underwriting to go faster and more efficient. And even if we just take one step back and look at what is being done on the traditional side, insurance agents are also looking at faster underwriting process to close the sales more quickly. In this pandemic situation where the face-to-face interactions was limited to some extent during some time, this is also something that is driving the changes in the way we do underwriting. We want to look at faster way of doing underwriting. We want to do it real time, like what you mentioned. So, so this is the trend that we're looking at. Theoretically, we can get all the information from the applicant, right? So the applicant can, do this behind the computer screen. They can sit down with the financial advisor. They can provide everything, and the information is key in, and then the information goes into the engine to produce the underwriting results. So information comes from the applicants in terms of claims history, the health status information, biometrics, which can be captured in the last medical report, for example. So I think the question is really, how do we verify the information? How do we get the information that is important, that is necessary, but not provided by the applicant for any reason? If we are able to get information in this of this quality, I think it definitely speeds up the data flow process, and it definitely allows us to do real-time underwriting. So I will reframe the question slightly to ask how we can get data that is verified and complete into our system for underwriting. It can be done if the information is digitalized, verified, and centralized. We have seen examples of this being done in different countries. We have digital personal data platforms that are run by government bodies. We have this running in Singapore, which is called MyInfo. We have electronic medical record system that is already in place in the US and other countries like Estonia. So if insurance companies can tap into this database, we will be able to obtain the information quickly to do the underwriting. But it is impossible for the insurance companies to try to do this on their own for obvious reasons. This is better driven by the government. So a government-led effort is really a key success factor here. I also want to quickly cover some other developments in the underwriting space where we see the creation of new underwriting approaches and frameworks. This may result in the use or requirement of fewer data inputs or information inputs, or we are using another set of information input as well, such as social economic information that is coming from the information that is from the banks, from service providers, from e-commerce companies. So we are sharing more and more data with all these companies, and we know that bank assurance is already running and getting a lot of traction in a lot of Southeast Asia countries. Banks capture information about your income level, how you use your income, how you use your credit card, your spending patterns. All this creates different types of data, and the work is therefore focused on whether we can make sense of the data to develop the science and application to make underwriting work in a different way. So if we can find a strong correlation between different variables and how they interact with the claims experience, then that is possible. And the question after we have the science is really making sure is how do we ensure that we get the data from these company systems into the underwriting engine so that we can do the underwriting in real time or near real time for our customers.
So your comment kind of overlaps in some sense in relation to the bank propositions around credit analysis and things like that, right? And I think you brought up an interesting point that is, I suppose, parallel to what one of the panelists mentioned this morning, right? I think the guy from our panelist from Grab Insure, he was saying every additional underwriting question, causes a 10% drop in relation to take up. But your comments, is in relation to having it real time with the agent to back and forth with the customer. And I think that creates a different perspective. You can ask more, but if you ask more and answer fast, it's definitely an alternative way of thinking about the whole thing. So in relation to expanding access to health insurance, are there other opportunities beyond what else you commented?
Is this for me or is this open to all panelists?
The other panelists can also comment.
Right, maybe I will kind of leave it for others to give some feedback or opinions.
Adrian, your video is off.
Yeah, so I think maybe I can comment on expanding access. I think it's such a good opportunity also once you have that data to look at the risk factors that you want to manage. So I always think, in health, high risk does not, or low risk does not necessarily always mean healthy. I think it's also, the behavioral patterns of do someone visit a panel hospital versus non-panel, the waste experience, things like that. So I think if you can set up a product or a system that's dynamic in the sense that it rewards the right kind of behavior, then, we've seen this kind of products being developed for diabetes, for example, where, you can actually cover someone with diabetes as long as they take their HbA1c tests and they do all of the different risk behaviors. That would mean they would be lower risk, even though they have pre-existing conditions, they'd still be a low risk category than others. And so they can actually also be covered by insurers as long as their condition is well managed.
Spencer, you'd like to make some comments?
Yeah, so in terms of expanding access, making health insurance more accessible to different parts, to different segments of the population. From the product angle, we are definitely seeing more products for people who have health conditions that do not allow them to buy insurance previously based on the underwriting practices that have been put in place. Products for diabetic patients, people who have undergone treatment for cardiovascular diseases, CVDs. So these are examples of products being launched to allow more people to buy insurance if they were not able to buy previously. We are also seeing products that try to make premiums more affordable. plans that have deductible built into it. This is designed to work with the national health insurance system or the employer benefits. We are also looking at critical illness medical plans that have gone into the markets, and they have gained traction in some markets as well, a lot of traction. To this cover treatments that are for selected critical illness because of the lower claims incidence. We are able to offer the product at a cheaper price if we do the underwriting right. So all these efforts help to make health insurance more accessible. This going back to the products for people who already have some health conditions. Working with the data to develop the pricing basis is not trivial, but it is relatively more straightforward compared to the implementation. If we have the data, we can understand how the severity and the progression of the condition drive the claims experience. Therefore, we can price for it. We can develop the product and offer it to the market. And the data will come from hospitals, public healthcare institutions, your own insurance database as well. When over time people become ill chronically, when they have certain conditions that are linked to the ones that you are trying to provide cover for, you have claims data that is coming through. What I think would be a more interesting discussion topic is how this can be done in the private medical insurance space, where we have profit targets and financial issues to manage versus public healthcare schemes and systems where everyone is covered. And naturally, there is more effective pooling of risk. There is going to be better allocation of resources at the macro level to manage costs and outcomes to reduce burden on this group. In PMI, because we can only offer to a smaller segment within this group, the anti-selection risk is likely to be present. Why I say that we only offer to a smaller segment, using diabetes as an example, we need to, because we only understand so much of the risk right now, we have to also look at the affordability of the premiums. We set certain limits. We draw the boundary. We say that, for example, we only offer to people who have HbA1c of below 10, for example, just throwing out some numbers there. Then we try to look at this group, but our experience thus far has shown that the mix of people that are trying to buy the product is actually quite different from assumptions. We think that it will be closer to the demographic representation, but actually it is not quite the case, right? We see higher risk groups trying to buy the product. These higher risk groups are people who are at the limit or above the limit. So we're not getting enough of the better risk. People who are mildly diabetic, they're not coming in. There's some kind of a behavioral factor at play here, I believe. If they think that they are in relatively good condition, they are keeping it under control. They are doing a lot to make sure that they don't deteriorate. They would not want to pay too much for the product compared to a standard life. So maybe 10-20% they're willing to pay for it. But if you're asking them to pay 50% or more or 2 times the standard price, standard premium rates, I think that is not what this group is looking for in terms of value for money for health insurance plan. So we get higher risk groups buying this product, which creates anti-selection and business mix risk. On top of that, we need to develop the appropriate underwriting, claims, policy administration processes just to manage this new cohort of policyholders. So all these take up bandwidth and can distract the management from the monitoring and management of the standard health business, which is already challenging by itself. So I think there is a lot of challenge trying to do this in the PMI space, but it can still happen. What we have seen more successful or more effective is really the national health schemes, which is successful for the reasons that I've outlined. But if we are looking at the success of these products in the PMI space, I can think of a few things that need to come into play to make this work. Disease management programs to help members manage their conditions. We need to invest in health administration systems to manage the portfolio, to monitor the business. Just some examples there.
Okay. Yeah. That whole topic on leading a horse to water kind of thing. That one is another hour-long panel discussion. Okay. Now we'll go to the audience Q&A. Do put in your questions. Potentially on a post-lunch basis is a bit challenging. I have a Adrian, you want to comment?
Yeah, I think while you've got questions coming in from the audience, I just wanted to comment a little bit on the last point, because I have a question rather than an answer myself, and that is to the extent that we are getting more data in and getting better at underwriting. The extreme of that situation is that the insurer will get better at predicting risk and better at pricing to that risk, which undermines the principle of insurance, because the principle of insurance is unknown future events and creating a risk pool. And if you are getting so much data and so much information that you can almost perfectly predict what the claims risk associated with an individual is, the sickest and the poorest risk in our society will find themselves either priced out of cover or without any cover, because the insurer will know so much that they will price them up for it. And you then get to an ultimate result where you get an individual price per customer and no more insurance pool and no more unknown future events. So I think there's probably something for us as insurers to debate as to what extent do we stop using data and continue to focus on running insurance pools or running insurance portfolios to grow our volume of customers rather than getting to perfection on price. So that's just a reflection for me. I don't have the answer, and maybe if the other panelists want to comment on that.
It is a bit odd, or rather, as far as e-commerce is concerned, right? It was perfectly acceptable for Amazon to sell different people the same product at different prices, right? And even airlines does it. You use incognito mode versus you go and visit second time, third time, prices automatically go up, right? So as we go to the Q&A, I think Adrian, you definitely kickstarted the Q&A because we have a big bunch of questions now. One from Palvanan, it's a pricing risk in relation to targeted segment, and he commented that you already answered it. I think what you mentioned also alluded to the first question, right, in relation to, or rather my comment, where the larger your participant pool, if you hold the benefit, you get a lower price. But at the same time, if we are talking about targeted segments, for example, diabetes and whatnot, the more participants you have doesn't necessarily mean you reduce your benefit. That was what Spencer mentioned earlier. The issue is around getting a decent spread of types, mild versus severe and things like that. Right? One attendee was asking, how has the sales been like in relation to medical products for diabetics? Does any of the panelists have experiences around diabetics?
The previous question, maybe I try to answer that first, which is related to the pooling of risk, right?
Yeah.
I think when we start to look at segments, the pooling is already being limited to that segment. When I was talking about the diabetic product, we were looking at a segment, and basically within that segment, there are also people who have different, who are at different severity or progression of the disease, right? So we are saying that it can be for HbA1c of 7 to 10, for example, or even higher than that. So there is a range there, and within this range, there is some pooling that is obviously happening, but maybe not at the level that we want, based on the actual experience of the take-up rates, of the take-up of the products. But pooling is, is being done there. The reason why we can't do more is really driven by the business and the financials, right? Because if we start to pool more, from an insurance point of view, you are definitely going to have people who are more likely to claim and who are likely to claim more. So when you pool them together, you have on average a higher claims cost, and therefore to sustain or to still meet your profit targets, you need to then set your assumptions higher. This makes your product uncompetitive for the standard products. So I think all this causes a dilemma at the insurance side. So it's there is obviously the intention to do more pooling, but because if you do more pooling, it impacts you in a different way, then you're not really able to go out to do the pooling. So that is also one of the reasons why there is that distinction between doing this in the public space versus in the private space. And yeah, like I said, it is we have definitely seen more successes at the national healthcare systems. Not it's quite tricky to do it at the PMI, but it is already being. I think pooling by bringing in this risk to some extent is already one step forward in terms of helping to make healthcare more accessible and trying to bring people more into the insured pool, right? Obviously, it can be done in a from certain angle a better way, but there are limitations and challenges that we need to be conscious of, and some of these things cannot be managed away.
Okay, I saw that some of the questions actually will be, it's more appropriate in relation to our subsequent section. So I will push it to that part. But nonetheless, please continue keeping the questions to come in. Kirti, you like to make a comment?
So Tiva, yes, to the questions which you highlighted earlier. Now, I just want to share an example on the diabetic product. So in India, Apollo Munich launched a product which is specifically for the diabetic people, and it covers only people who are already suffering from diabetes. And they launched it in 2013 or 2014. The expected volume, with all the reasons, as Spencer mentioned, it cannot be expected to be high. But the strategy I think they have gone ahead with is people who are diabetic, they control their own health a lot more than a normal person. So they are very careful, they are very conscious of the everyday routines, what they need to follow. So there are two sections, or there is a division of people within diabetic population. One who maintain their condition very well and actively. And this helps to balance the other population. So what I can share with you, as per my information, the product is actually sustainable. Volume is not very high, but it is still sufficient, or it is as expected on this product. So that can be one of the ways to look at it, that there is a mix of pool of people who are managing it very well and others who are not very well.
Okay, that's an excellent example, Betty. Thanks. So in the interest of time, we'll move on to our next part, right? Claims and medical providers. Obviously, in relation to every dollar of premium collected for health insurance, the biggest chunk is paid out as claims to medical providers. Very often, this relationship between medical providers and insurer is antagonistic and zero sum. Right? Every dollar additional your medical utilization is, the insurer gets $1 less. So how do we do preferred provider networks better? Adrian?
So I think a few comments on this one, and I'll be controversial just to stimulate a bit of discussion here as well. I think the first one is, and we can call it networks or panels. I think the first comment is what is the insurer's purpose with the network? Is it to limit costs, or is it to provide access, or is it to infer some kind of quality kite mark to the network? So in selecting a network, does the insurer select that network because of cost? And is it engaging with providers to say, well, if you want to come into my network, you need to charge me a certain fee, and therefore I can curtail costs by paying a fixed fee if you're in the network, and that would be cheaper than the otherwise cost that you would charge in an open market. So if in that case the network is there to contain costs, it also allows the insurer to look at the network and manage utilization within the network, to track providers, to see within that network which provider is over servicing customers, is doing more things. So for example, let's pick an example of a ear, nose and throat specialist who sees children. Are they giving more grommets to children for the ears per capita than is the average? And with good systems, the insurer can track that and see Dr. A within the network is giving 3 times more grommets per capita than Dr. B in the network, and therefore Dr. A is out of line with network behavior. They can then engage with Dr. A and say, you're out of line with the network, and you need to curtail your behavior, otherwise we're going to remove you from the network. So having a network then puts in place a control to stop, or an incentive for the doctor to stay within the network by regulating their clinical practice. Now, if there were doctors on the panel or doctors on the call, they may have a view that says, you're compromising my ability to practice medicine independently. I think networks definitely work from a cost point of view. I think when the issue comes to trust, there's an interesting dilemma as to whether the customer will trust their doctor more than they trust the insurance company. At the moment, I would say that customers tend to trust the doctor more than they would trust the insurance company. But if you can build a really strong insurance brand, customers will then trust the insurer to keep the doctors in line, and get good behavior out of doctors. And then my final comment on this is, there are in a world of big data, there's a lot of data out there for the insurance company to track good and bad doctors. And if it can get to a stage of building a network that is a quality assured network, that will lead to good customer outcomes. And it's often the case, and I'll talk from personal experience, you go to see a GP and you need to be referred to a consultant or a specialist for some treatment. As an individual, you don't know who is good and who is not good. So would you rather take the recommendation of an individual GP who does not know the market, or an insurance company who has access to all the data and all the clinical information and the outcomes information of the various specialists, and get referred to someone that the insurance company, through smart use of data, has determined is the best? I'll use grommets as an example, is the best for grommets, or someone that your doctor happened to play golf with on Saturday afternoon with, to get your grommets done. And that then changes the role from the insurer to simply a payer of claims to one that provides guidance and direction to me as a customer in terms of where to go for the next stage of my patient journey in terms of best quality outcomes and best quality care. And I think if we can get to that, that would be a great outcome for networks or panels, and it would be take it beyond the antagonistic zero-sum game. It would be a win-win for the insurance company, a win-win for good quality doctors, and a win-win for customers as well.
That's a good point, Adrian. I think the challenge around data, has always been for actuary. Number one is analyze it, but number two, to present it back, right? Whether it's to management or even to your policy holders as a whole, that this doctor is better, this doctor is, it's not so good, and in a very compliant or it won't trigger a lawsuit type of situation. So those definitely are challenges, and as insurer takes baby steps, or even, for example, in Singapore's context, right, the government started by showing average cost data per hospital, then they changed to now showing per procedure what is a typical suggested price, among other things. So I think more transparency and more data is the way forward. Exactly how it looks like, I suppose is a challenge. So moving on to our next question, right? Our theme here is the augmented actuary, think global, act local. So this is an open question for all the panelists. What are some global trends in technology that is relevant for health insurers? And as a corollary to that, what are some quick wins you guys potentially are working on, and what technology you guys have big hopes for?
I think I'm happy to jump in here. I think the key thing to remember when looking at things like technology and AI is that these are not necessarily solutions in themselves, but rather tools that can enable us to implement better solutions to manage claims. So the solutions will still always be the starting point. So I think figuring out things like how can we promote wellness initiatives, and making people healthier or reduce fraud, waste, and abuse. So I think when looking at health promotion and disease prevention initiatives, for example, that reduce claims to insurers, one solution or global trend that I find quite exciting is the coordinated care model, much like with the IORA model that L.E.A.D.ing presented yesterday. I think data and technology does have a great role to play in these solutions, particularly with the electronic medical records or personal health records, providing the information to the health coach or the central coordinator to assist in providing the right level of care at the right time. And there even AI can then assist with the central coordination role to reduce some of the administration for health coach or the nurse. I think these models seem quite a long way off, but there are already small elements of coordinated care implemented in many markets in Asia. If you take specialist referral, for example, it is essentially putting a GP as a gatekeeper to manage the cost of specialist care. And so I do think there are smaller steps that can be taken by insurers in the interim to move towards more coordinated care models. But I think the focus in many markets for insurers, especially with a large health protection gap, is growing market shares, like we discussed earlier. And I think that selection effect is also then used to manage claims. And I think in this case, it's quite important that we then look at integrating decision-making analytics across the customer journey. And for that, I find, what motor insurers are doing with looking at predictive models for technical pricing as well as behavior, taking those building blocks in how they analyze their data with selection and portfolio management. I think there is some potential for that in wellness initiatives as well, to look more at behavior in claims, to find optimal solutions to manage selection and also then the – average claims in a portfolio.
Any other panelists like to jump in? Okay. I think we can go back. Spencer, you like?
Yeah, I'll just add a few comments on the use of technology in the claims management space. We have definitely seen developments, a lot of developments when we have more digital systems which can capture data. This becomes a natural area for us to invest efforts in, looking at how we can make claims management processes more automated, more efficient, and also more effective. Um, we talk a lot about AI and machine learning. I just want to make a comment about the need for claims rules to form the basic or fundamental building blocks. This is important as we try to bring in AI and machine learning into play at a later stage. So the claims rules, they are there to help us to manage the majority of the claims when we try to do this in the beginning. When when claims are falling out of these rules, meaning that they get referred by the system, we if there is genuinely an issue with the claims, I think that is all good. But if it's because the rules are too static, they're not refined enough, they're not specific to the markets, then this is where the AI and machine learning comes into play. A lot of the rules in its current form, I feel the ones that I've seen, anyways, just to make sure that I put in the caveat, they are quite one-dimensional, meaning that if you have claims that comes through when I pick up the diagnosis or the ICD-10 code, when it tries to look at whether the length of stay is reasonable, it just uses the ICD. It then compares against the corresponding average length of stay or the range of length of stay that is associated with this diagnosis. It doesn't take into consideration your age, whether you have other comorbidity. So the value add from machine learning is really the creation of new rules based on how claims managers are making decisions on the ground on complex cases using a wider range of inputs. For example, a case comes in, actual length of stay is higher than the benchmark. But when the claim assessor looks at the age, somebody who is older, who has other conditions, there is a secondary diagnosis, then these become additional decision factors that are key. So AI will help to refine the benchmarks dynamically. It will help to create more sophisticated rules. I just want to mention that all these things is really an enabler, which is in line with what Lydia has just talked about. So it is part of an information system that gives you information faster, that gives you information that is more complete to support your decision-making process. The intervention part is very important. This is the process that helps you to really achieve the claim savings, right? So if you don't do anything, you don't decline a claim, you don't challenge the providers, you don't talk to the physician about this, the claims stays as is. So you don't really get any impact from using your claims engine or your claims solutions. So yeah, just wanted to make sure that we understand that AI is useful, but ultimately a few of these pieces are also very key. The rules, the claims managers still make the decision and they take the necessary actions to manage the claims. Thanks.
That's definitely a good point, right? I mean, when we talk about augmentation, as far as technology is concerned, it's really about highlighting and showing people timely data, and if you present it in an easy manner, then people can work faster. It's more like automated, right? In the sense, yeah. So on that basis, if no one else has any more comments, I would then like to move to the Q&A. Okay. Yeah. So there's a comment here on the Holland insurance system where everyone pays the same for health insurance regardless of age. Community rating. And if I'm not wrong, this is also similar to South Africa. Would our fellow South Africans like to make a comment?
Yes, I think in South Africa, insurers can rate. So they've got child rates, adult rates, and spouse rates, and so those are the rating factors that will essentially can be used. And so what happens? It's the anti-selection effect. So if you compare, who's got cover compared to the population, then you typically see a dip around the ages of 20, and then an increase again at maternity ages, because maternity is a prescribed benefit that insurers have to pay. And then a very high, take up of insurance at the older ages, which is quite opposite to what you would have here, where the older ages can't afford it. So of course that, that system adds a lot of costs. So it's with community rating, there needs to be some sort of other mechanism, which I think which helps with anti-selection. And I think that's something in South Africa that's debated quite often. Is there's first of all, there's no risk equalization system to help transfer risk based on the types of lives that insurers cover, and there's also no universal health. So there's nothing that incentivizes the younger individuals to also take up insurance, even though it's going to be more expensive for them. So I think it's a continuous debate, and I think that's the key thing, is just to have the selection or the coverage in such a way that you can actually cross-subsidize and make the premiums more affordable. I think that would be the key challenge in such a scenario.
Okay. So there's a questions, two related questions actually. One is in relation to what does the panel think is the best way to pay medical providers, right? Do you hire literally on a salary basis, similar to Kaiser Permanente provider as well as insurer, right? Or do you pay them per episode, or do you pay them per year capitation and outcome? Of which related to that, is one of our attendees from healthcare is commenting that their capitation rates, I presume from the government, is using patient factors. Yeah. Throw the question to the panel.
I think that in an ideal world, outcome is by far the best way to remunerate providers. I think there is an element of subjectivity in measuring that outcome, and sometimes those outcomes take a long time to occur. In certain instances, the outcome may not be what the patient wants it to be, where the doctor tries their best but does not succeed. In that case, you still need to pay the doctor for the amount of effort. It's not the fault of the doctor for failing to cure the patient. But if you could create some kind of outcome-based incentive, I think that would be ideal. Failing that, I'm not a fan of capitation. I think it drives the wrong behavior from providers. It drives providers to avoid seeing patients, and therefore I'm left with episodes of care as the second best alternative in terms of remuneration model, but with some sort of reward for outcome, which may simply be that, going back to my earlier comments, that the reward for good outcomes is that you remain in the network and you remain accredited as a provider for that insurance company.
I think maybe a comment also is I think a key challenge is also just that there's so many different types of providers. So even in one episode, you'll have different payment systems. So and also when you're looking at things like outcome, which incentives and how do you pay the different providers? So different payment mechanisms might be more appropriate for certain providers as well. And I think the key challenge, especially, big episodes in the hospital setting, is just, identifying the individual who's responsible for the care. And I think that's also, again, coming back to coordination and, centers of excellence and all of those group kind of systems that you can use more holistically care, rather than having, the different types of care all working independently.
Okay. So over here, there's a question around what can the health insurance industry do to be more transparent with the data they have. The Singapore example is that they have not played an active role in relation to informing and educating clients using data. Kirti, you'd like to comment on this?
Sorry, T.Y., which question is it?
It's a Q&A from our participant regarding what can the health insurance industry do to be more transparent with the data they have? Yeah. In the Singapore context, they have not been informing and educating clients using data. This, to some degree, is in relation to Adrian's comment about creating a trustworthy relationship between the insurer and the policyholder. But in the short term, or today as it stands, the policyholder trusts the doctor in front of their face. So on the industry as a whole, there is a challenge in presenting data back to the policyholders on our steerage, the insurance company steerage to XYZ provider is not purely based on cost, because outcomes really matter. You want the policyholder to continue healthy. Okay. Oops, sorry, somebody is commenting that my voice is a bit soft. Yeah. Okay, thank you. I think for the, oops. Right. Let's jump over to the next part around market developments and regulators. Right? Health coverage is critical, and we spend a lot of time discussing accessibility and affordability. Right. So looking at the leadership and execution using actionable data. For the panel, which recent initiatives in any market do you think are beneficial? And was it industry or the regulators that showed leadership? Adrian, you'd like to start off?
Yeah, thanks. I'm going to quote two examples here. The one will be a UK example, and the one's an example from UAE or from the Dubai market. So the UK example is where in the UK, the regulator, the FCA, the Financial Conduct Authority, has for a number of years had a requirement for the insurance industry to treat customers fairly. This has led to good outcomes for customers, but the whole TCF, treating customers fairly framework, is very much focused on process. So how you go about dealing with your customers leads to good outcomes. They've also focused on ensuring that you look specifically at your vulnerable customers and don't disadvantage them. And I think when we talk underwriting and those sorts of things, and linking to the conversation earlier around diabetics, a vulnerable customer may be a diabetic that you would otherwise exclude from coverage if there weren't requirements to have consideration of vulnerable customers. I think the recent development that we're seeing is that the FCA are looking again at TCF, and they've concluded that TCF, or treating customers fairly, is not sufficient. And they have now asked the industry to consider fair value for customers. And this is something that those of us active in this market are working through right now, because fair value is about the outcome for the customer. TCF is about the process. So you may have a process that's really fair, but the outcome is that the customer does not get fair value. Fair value focuses on making sure that your process is fair to customers, but also ensures that at the end of the day, the customer gets some fair value. This came off the back of a study that they did on the motor and home market, so not on PMI or health insurance specifically, where they found the practice was what's called price walking, where you, as the insurance company, brought in a customer at a low price, at a discount, and then relying on the customer not shopping around every year, you price walk them, or you move them up to a higher price because you relied on their apathy in terms of shopping around every year, and therefore their price went up and up and up each year as you remained loyal to the insurance company. And effectively it was a loyalty penalty rather than a loyalty reward, which is, I think, the opposite of what you want. So I think it's a good example where the regulator is intervening to create a better market, and a better market for customers. I think us that are active in this market are still working through how we will ensure fair value, but it seems to be the right sort of thing. The other one was the DHA in the UAE intervened to require that on renewal, the insurer was providing more information, particularly in the SME market, small medium enterprise market, to companies in order for them to shop around and get better rates. It was practice in that market for very little claims information and loss ratio information to be provided to ensure companies to go and get quotes from the market. It led to people being quite loyal and staying with their incumbent provider. What this requirement did, it said you needed to give them their claims information and loss ratio information. They could then go to other insurers and see what the rates were in the market, and then potentially move your cover to someone that was offering a better price, which again, I think leads to greater transparency and a more efficient market, because of the market has more data to work with. So I think to kick off the discussion on that, that's two examples where I've seen really good regulatory intervention.
Yeah. Kati?
I would like to share another example. The example is from India. So, it's not very recent, but I think around in 2016 or 2017, the regulator in India introduced standardization of some wordings in the health insurance policy. It was around 40 or 50 wordings that they have standardized. Now, from one perspective, it might look like standardizing benefits means that there is no competition or no room for the competition left in the market, but not really. Actually, the problem which was faced in the industry was there was a lot of room for the for movement of a client from one insurer to the other, portability. But the terms of the insurance policies the definition specifically. Even when the intent is same, they are worded so differently that for a layman or even for the agents, it becomes very complicated to do a comparison side by side. So it was a good initiative, according to me. It was a good initiative because it has put across the transparency that, okay, all this set of wordings are standard or definitions are standard. Now, how the insurer wants to offer those depends on the insurer. So it removes a part of the ambiguity from the customers, that maybe it is worded differently, which it means different. When I'm moving my policy, my coverage might be completely different. So I see it as a good move and not really restrictive that they implemented something like that.
Okay, these are, go ahead.
Sorry, I just wanted to, I think standardized policy is quite an interesting one, and we do see it across many markets. I think like recently also in Thailand with the OIC issuing standard policy wordings, and that's really also just to help with regulatory processes to make it quicker for insurers to put new policies or to launch new products without having to have long waiting times for the regulator to give approval. And then the other one is also, prescribed minimum benefits, like I think in Vietnam and South Africa as well. And I think in a lot of cases, it's looking at the mix between public and private funding. So a lot of times it might be taking some of that burden of the public funds to move more cost to private insurers as well. So I think it's always a challenge for regulators as well, because it's looking at the overall health system. So both public and private to make sure that, both function well. And I think that's quite a key challenge often with different markets to see how can both public and private be offered sustainably and affordably.
Spencer, you'd like to make some comments?
Yeah, I was thinking about the Thailand example, which was mentioned. I think a lot of the initiatives right now are trying to make information more accessible, or to reduce the asymmetry between different parties, between different stakeholder groups. That is also linked to the question around how do we make data or information more transparent, which is one of the questions that came up. All right. I mean, to be honest, it is difficult because the information can be used in different ways, and it will, depending on how you provide the information, it can benefit certain groups more than the others, right? So it's always going to be very difficult to do this, whether it's about sharing of information, whether it's trying to, for example, standardize wordings or contracts, right? You in a way, you try to do something, but it also means that a lot of effort is being put into trying to make sure that they are focusing on pricing, focusing on claims, making sure that assumptions are sharp, making sure that leakages are minimal, and then to some extent, I don't know, it can impact on the bandwidth that is required for more creativity work, for more creative work, to develop new products and things like that. So it makes it challenging for someone to want to make a first move in the market potentially, because of all this leveling of the playing field. So it can work in different ways. Hopefully, it's executed in a way that achieves the desired outcomes.
Okay, that's good. Let's go to the Q&A. Yeah, so Hitesh, the reason why I love this question to the back was, Hitesh brought up a good question. Everyone's wants a good risk, right? But if you want to insure more people, what suggestions do we have? And taking into consideration discussions that we've been having, starting from the front underwriting pricing, the claims, and obviously we're not operating in a vacuum. markets and the regulators do matter. Otherwise, you do it alone. I mean, the thing about heroes die young, that does happen. Right? But if the regulators start to put some base rules, then things are a bit more reasonable, and everybody can go after more people. Gertie?
So very interesting question, I would say. I think our products today are very complicated, or over time we have made them quite complicated. Today, if you open the policy wordings of any of the health products, they would be running like 40 to 50 pages long, or at least 20 pages long for each of the coverages that we have. What it means for the end customer, if you think about it, it means there is something, it's like a legal document. There is something I don't know what I'm covered for really. Also, in addition to that, the structure of the product is mainly to address the fraud-based and abuse to an extent. We want to word in everything inside the policy wording so that tomorrow, whenever there is an abuse, we want to prove it using the wording saying that we are not going to pay for this. I mean, we go to an extent saying that we will pay for the goods, for example, and not for the wheelchair, if you are offered the wheelchair. So think about it. I mean, from a design perspective, we have made it so complicated over years by including each and every detail of the product, what we are going to offer, what we are not going to cover, what we are going to cover, just to control the cost. Similarly, having the products with the sublimits, limit at each and every place, having co-payment, it looks like the product is very customizable, and it also looks like we are offering a variety of things to the customer. But from the end customer perspective, it is really complicated. So I think there is a pool of customers sitting there who want the insurance just purely for the insurance reason, and they do not really are interested in all these ifs and buts and details of it. So one of the ways can be simplify the product. Maybe it's time to actually have a very simplified product, which simply tells you if you go to this hospital, you are fully covered, whatever your treatment is from end to end. You don't need to worry. Maybe just two things. You need to have this, you need to be admitted to this bed type and this what type, that's it. No more details, no ifs and buts around it. So specifically in Singapore context, we all know that from the government restructured hospitals, there is no fraud, abuse or anything expected from the government restructured hospitals. But none of the insurers today offer a product which is open. You go to the government restructured hospital and we will cover you for everything. None of the products say that. Obviously with the underwriting at the start. But yeah, maybe such product ideas which are simple to understand can actually bring a change in the customer buying behavior, and we can cover a wider population.
And so maybe to add to that also, I think when looking at risk, I think in an ideal world, we'll look at how we define risk in health. Ideally, I think, you want to price and provide products or insurance based on risk that customers can control and pool based on risk that customers can't control. So for example, not on disease or health risk, but rather on behavioral risk, like I said previously as well. So if we can provide incentives and price and products based on, controllable behaviors rather than things that's outside of the control, like disease risk and things like that, I think it just could change perhaps the pooling of risk, and then also help to manage the claim side to help to drive patients or behavior and services in the right direction to reduce overall cost through better incentives as well.
I once worked with the chief risk officer, and he used to make the statement, there's no such thing as a bad risk. You only get a bad price. And that stuck in my mind. And I think if you want to insure more people, you can't just insure good risks. You need to find the bad risks and insure them as well. But you need to find the right price to charge them. I think we've touched on some markets like, I think Lydia was talking about Vietnam and South Africa, where it's community rated and that becomes more difficult. But where you're able to charge according to risk, you need to find the ways to price appropriately for the good risks and the bad risks. And then the challenge for you as the insurance company is to keep that price to make it as affordable as possible through providing bang for your buck in terms of value for money, making sure that the customer gets as much value as possible through other interventions, through good service, through good claims management, running good networks, etc., to make sure that they get their value optimized. We spoke a little bit earlier around data and AI, for example. There are things that insurers can do to eliminate fraud or significantly restrict fraud, and there's a lot of leakage in the industry that comes from fraudulent activity. So using big data, machine learning, etc. Some estimate that there's probably 10 or even 15% of claims are paid for fraudulent claims. That would be an example of some efficiency that you could generate that would just help to make coverage more affordable.
Okay, so in some sense, this question on what if health insurer can no longer underwrite or do selection of risk is, in that sense, answered. The simple answer is the price will just be very high. But I think in relation to the discussions that we've been having, I think there are opportunities for targeting. You can skip underwriting if you target very narrowly, but at the end of the day, I guess you're also doing risk selection. So please keep those questions coming, right? Is there an efficient market hypothesis in underwriting? If this is in relation to profits, I guess, right? Or in relation to price. If the price is too low, then and the claims is too high, next year prices will increase. Right? If the pricing, underwriting, and price is too high, then the money will go into reserves and get paid out bonuses. Actually, this question I like Adrian to make a comment, because I think Bupa, in relation to COVID, did something very laudable. Yeah.
I've never thought of it in terms of an efficient market hypothesis, but I think in particularly in a commercial organization, one needs to always balance the need for profit and volume. And one just has to, you can price high and you're just going to lose volume as a consequence, and you can price low, you'll get the volume in, but you won't make enough profit, and it becomes, you just need to find that sweet spot, which is enough volume, because volume is an engine for future growth and future profits, but also you need to keep the company profitable. So I'd say, yeah, I've never thought about it that way, but I would say implicitly in running an effective health insurer, there definitely is an efficient market hypothesis and a sweet spot in terms of that trade-off between price and volume. Probably the only other comment on this is I think you've got a third aspect, and that's customer. And every business deals with customers, but I think health in particular, the customer is really important, because people's health, there's a very human aspect to it. And if you charge too much, or you automate too much, and you service customers through automation rather than bringing in human contact, I think that could disaffect and lead to your customers leaving you. We tend to, from a claims point of view, often deal with people at the most vulnerable time in their life, when they're really ill and they're looking for support. And when I'm really ill and I'm looking for support in terms of how's the best way to get treatment for my heart condition or my cancer or something else that's seriously wrong, I don't really want to talk to a machine. I really want to engage with a human on the other side that's empathetic and can provide me with personal support. And I think this is probably tangential to the question, but I'd say in terms of an efficient market, the efficient markets that we need is one that retains that human aspect in it, because I think health will always have much more human touch than some other insurances. Maybe I'm just old school.
No, I think, I mean, as effectively a panel of health actuaries, right? Clearly, you know, the loss ratios are higher than other products and whatever not, right? But we still continue to labor at this because the simple fact it remains necessary. The only way to pay for health on a long-term basis is to pool risk together. Spencer?
Yeah, just wanted to add a couple of points there. I think there will be a lot of other market factors or other external factors at play here. If we want to loosen underwriting, theoretically you can do it. You know, if the risks that are coming to you are, you know, still the risk that you're expecting. If you swing to the extreme end of the spectrum and decide to do a guaranteed issue offer to your customers for your health products, well, you should expect the claims to go up, right? And then in a way, if your product is you know, similar to what your competitors are offering and you are not making money, you have to make adjustments to the prices and premium rates, then you going to be uncompetitive. So if you want to get back to a position where you are in line with the market, where you are making profits, you are getting in volumes, then you will have to tighten your underwriting. You cannot do GIO or SIO, for example. So this is, I think, a lot of considerations come into play. So you know, in some of these markets, the insurance agents are very influential. So if the underwriting is too tight and they look at what other companies are doing, then there will be obviously you know, a feedback and coming from them, and there will be adjustments that will be made to make sure that they can do their job effectively in the market. So yeah, so I think it will be determined by a lot of factors, right? So it is not an easy question to answer whether we can you know, whether we should do very strong underwriting, we should strengthen it, or whether we can loosen it. Yeah.
Yep. I mean, sounds good, and sometimes potentially to the lay person, you know, when they look at the numbers on premium versus claims and stuff like that. In Singapore, it was recently a big issue where the local medical association, right, commented about integrated shield, which is also a local something like a universal healthcare plan with a private top-up, right? Then there was some lengthy discussions back and forth on, you know, claims versus costs of administration, you know, versus premiums. So I think, yeah, it's, anybody would like to comment on that? No? Okay.
I can.
Okay.
So I think the plans are standardized and plans have been existing for some time now. I think it's about studying the data and understanding where can we actually make a difference, because we have all the data. So I think it's about seeing what difference did it make in the past few years, and do we really need those kind of rules and regulations inside the product. And studying that data, I think, would help to understand how much change the product can actually have without really impacting the profitability of it.
Yeah, so the reason why I brought up the discussion on integrated shield is because in this question here, what are the views of the optimum size for health insurers in a small market like Singapore, right? More insurers, more competitors you will have more innovations. But at the same time, if there's fewer insurers, each of them has more economic scale, they can actually negotiate better with whether it's the providers or in terms of administration costs. It's lower in percentage terms. With the panel, any comments on this?
I think it's definitely more of a challenge for smaller insurers, both to administer and manage claims effectively. Of course, if you're going to have fewer claims, you're going to have much more variability in your experience, and it's going to be much harder to identify trends and to understand, how you are performing, identify fraud and things like that. I think in that sense, a regulator would have a big role to play, just in sharing information, with sharing trends or sharing experience to help these insurers to enable them to just manage claims. I think also, you can get efficiencies through using third-party administrators, for example. I know in many markets, it's the administrators that really manage the panels as well. But then importantly, I think it was mentioned yesterday, this is how you incentivize those administrators to also manage claims. So to get those, work closer with the administrators to have the same incentives as well. But I do think, having smaller insurers is good to improve innovation, but definitely it's a challenge to compete then, with the bigger insurers who've got the bigger market share, and probably a bit more insights into what experience is, and what the standard benchmark is to work towards.
Okay. Right. So there's also another comment in relation to integrated shield, right? And building on Curtis' point around simpler products and easily understandable benefits. The Ministry of Health in Singapore does standardize a plan that is a top-up from the Universal Healthcare MediShield Life. B1 is a 4-bedded room in a local government hospital. But the comment is that the exclusions are still quite lengthy. And, do you think a policymaker has a role in simplifying these plans? Or actually, do you think the market is the one that should continue to push forward on simplification, bearing in mind they also have motivation to sell more?
I think both have a role to play, specifically for this particular plan, which is integrated shield plans. So standardization of the exclusions, which is a good thing across insurers, because it again brings a transparency, or I would say for the customer, it is good to have the same exclusions across. But to shorten this exclusion list, I think it's time to look at the data, how much it helped, or what exactly we want to exclude. What if we start covering it? I think these are the questions we can ask. And it can be both ways. Industry can come together, try to understand this, make a proposal, or actually the government can actually think in this direction and ask the insurers to make some changes. So both ways are possible. Also, some of the plans which are foreigners, which are specifically for foreigners, which are not really controlled or designed by the same as the integrated tree plans. There is a room to make them simpler, I would say. So I think we can actually look at the data, how much those exclusions have helped, and why do we really need those exclusions to make a difference.
That comment on data would probably be a challenge in relation to if you're looking at internal data, right? Because it is excluded, so therefore the data is not there internally, but externally there may be interesting opportunities.
Yes, that's a very good point. I think this is where the data comes in the picture. I think all health insurance, some of the health insurers are already doing it. But what is very important is when we do not pay a part of the claim, this information also is very important and should be captured in equal amount of details. Yes. So that education, I think many seminars in all the conferences I hear about it for last 10 years, I would say, but still there is a gap. And I think the gap is, as actuaries we understand this, but the gap is at a different level. People who are actually entering the claims, they also need to be educated equally, or they really need to understand that how important it is to capture this data. Because for them, if you think from their perspective, what is most important is to pay the claim accurately. And they are not wrong, that is their KPI. But I think that shift or that change is needed where we really capture the data, because data is everything. If you want to have any innovative product tomorrow, you need to capture all the data and all the details as much as possible.
So this question from Cheng Hot. Cheng Hot said hi to you, Adrian, earlier just now in the Q&A I saw. So he's asking, the proof of the pudding is in the eating, right? With all this hype around data analytics, AI, and big data, insurtech, blah blah blah. Are there examples of new health insurance products? Right. This question is a bit more challenging. For general insurance products, there have been many examples, right? But are there examples of health insurance products or significant changes to existing health insurance products in relation to the terms and conditions of existing plans anywhere in the world? Can you all hear me okay?
I think I can take a stab at that one. I would hope data analytics drive most of product development. Definitely, certainly in short-term products also, I think it's probably easier compared to a life company where, the product is long-term, so it's harder to change the terms and conditions. For a short-term product, certainly you would analyze your claims behavior and then change your terms and conditions based on that analysis. So you might add some exclusions where you see anti-selective behavior. And then also, I think what's interesting might be comparisons in cost for different providers. So one product that we have in South Africa is, sub policies where someone can choose to go to panel providers and say pay 20% lower premium. So that kind of differentiation and cost also based on different providers, that's all driven by data analytics and negotiations with providers on the back of that data analytics. So all of that I think feeds into product development and creating products that's sustainable to manage cost.
Kati?
I can share a very interesting example for this one. So again, going back to the Indian market, Apollo Munich again. So there was a product they launched, or a concept they launched 2012 or around that time, which changed the whole insurance proposition of the health insurance in India. And it is called floater. The concept is that a family when they purchase the insurance. So 4 of them together versus 4 individuals separately. This is much cheaper. I think analytically we all understand why, but again, data analytics showed this, that this is really true, that 4 people of the same family purchasing health insurance are much cheaper as compared to 4 individual policies. So the concept is to offer them a shared sum insurance, and this changed many things in the Indian market. So that was one of the innovations, I would say. And the way to calculate the discount. So the idea was to offer a discount whenever someone is purchasing a shared sum insurance. But if you think about it, in the whole family, you don't need actually individually for everyone the sum insured. You can actually share the whole sum insured because you don't expect everyone to fall sick or something very serious. This was only inpatient product. So it really worked very well, and there were, I think the whole market followed it from there.
In my experience, I think data analytics is more changing the way in which people are using their products, or the way in which the insurer is providing the product to the customer. For example, where there are panels and networks, data analytics is driving much more efficiency in that panel, as well as in the steering of people through a panel through their customer journey, rather than a new product per se. It's more how people access their products. I think the other big change that I've seen in the last few years, and particularly in the last 2 years over the COVID period, has been the advent of telemedicine, where people previously would have had a very personal journey, which involved going to see providers. Suddenly, technology and data is steering you through a virtual customer journey where a lot of treatment is provided through video or telephone, or other means, as an alternative to face-to-face contact because of COVID. I happen to think that that's a great outcome, and one of the unintended benefits of COVID is this move towards telemedicine, and I think it's generating a lot more data that insurers will harvest in the future, and has probably fundamentally changed the way in which our products get provided to our customers.
Spencer?
Yeah, another area will be wellness and chronic disease management. This is where we see the merging of data and all the analytics coming together, where we try to understand how risk factors drive claims experience, and then we look at these programs, whether it's wellness programs or chronic disease management programs, how they affect these risk factors over a period of time. And by bringing these two together, we are able to integrate wellness programs and CDMs into insurance products, and have a better understanding of how this can create better health conditions over time, can be used to prevent the onset of serious conditions, and so on and so forth. So this is another area where we see data analytics coming in, looking at very long tail of claims experience and how they interact with one another.
Okay, I think we've covered quite a lot. Yeah. Thanks everyone for joining us, and thanks Adrian. It's like super early for you. I hope the attendees enjoyed this session as much as I did. I apologize for my audio problems.